Is this just going to get worse?
Well, I think this is a glimpse of what the rest of these commodity markets are really poised to look like in coming months. Because we argue that these markets have gone from a period of pricing demand recovery, the big recovery coming out of COVID, to pricing scarcity. We've now got demand levels well above supply levels that has drawn down inventories, leaving these markets extremely exposed to any type of supply or demand disruption. So you take your point, hey, the wind quit blowing in Europe, you got a pop in the demand for natural gas, you have no inventory, and boom, you're at $22 an MMBTU right now. Put that in perspective, you're trading at $5 per MMBTU in the US. But this has the potential to extend into other markets like oil, because you're now pricing above diesel and you can create that fuel substitution. So we like to argue this is just a glimpse of something that's probably going to be much bigger this winter.
Okay, so what's the next market that can have this kind of parabolic move? I mean, we have aluminum at 3,000 now. What's next?
Well, when we look at pretty much most of the metals markets, and we look at the gas outside the U.S., inventories are now getting towards critical levels, which means which market do you see the disruption in? When you see the disruption, that's the one that's going to spike. So it's hard to forecast when you get those disruptions, whether if it's demand or supply. But the ones that are now, I think, brewing in the background are oil and U.S. natural gas, where the inventories are beginning to decline, particularly in oil. With IDA has already offset 2.5 months of OPEC increases. The demand hit from Delta was not nearly as large as anybody expected. Markets in a deficit. You've already exhausted the pandemic inventory glut. So you're slowly getting to a point. You get any type of disruption as you go into the autumn, the potential for oil prices to explode to the upside is increasing, particularly if you don't get Iran.
Jeff, if they go up quickly, are they going to come down quickly? I think back to the lumber story. I think back to the iron ore story. They went up like rocket ships, and they've come back down really strongly.
Well, that is the feature of commodity markets. When you get into these low inventories, price spike, and then they come back down because what happens? The price spike kills demand, brings it down in line with supply. Then demand tries to pick up again, then prices have to spike again to bring the market back into balance. You think about all bull markets in commodities, that is how they're characterized. High levels of volatility, lots of spikes. When you think about the investment vehicles, let's say like the BCOM or the GSCI, they're intended to take advantage and bank that spike before it comes back down again. And that's what these commodity investment vehicles or this backwardation is intended to do, is be able to bank on that spike. Equities can't do that.
Jeff, it just seems like the distinction between, say, natural gas and, say, lumber, you can just stop building a house, but, like, Guy can't let his family freeze, like in the UK, no matter how many sweaters that you put on. So I'm wondering if, instead of demand destruction, is it going to be substitution? So you're going to go to coal instead of natural gas because now it's a lot cheaper, or you're going to switch to different types of energy. I mean, like...
Absolutely. When we say demand destruction, substitution is another form of demand destruction. You just move into another form of the commodity that is at lower price. And you can sit there until you tighten that market. So absolutely, we're already seeing that, particularly outside the United States. I think the big question mark right now is how many diesel type of small generators are being used around the world to deal with this power crisis that's developing. And we already saw it in Asia earlier this year. So it's not unique to Europe. It's happening because we've not been making substantial investments in the ability to supply and deliver power and natural gas around the world.
Jeff, we've made huge investments here in Europe in the form of Nord Stream 2. It's finished. It's about to be certified. My real surprise at the moment is there's not much nat gas coming out of Russia. Is that going to change? How much of this is geopolitical?
Well, I mean, obviously, you had the disruptions. They weren't geopolitical. They were due to technical failures on pipelines. Now, the big question is, when will this be resolved? And then you have to ask the question, how much more gas is sitting behind those pipelines? You're seeing these same issues in oil and in other markets. Because, again, let's go back. We have not been making big investments in other types of long cycle activities around the world due to poor returns, lots of uncertainty about the forward. What do you know to invest in when the uncertainty around climate change is as high it is, and what technologies are going to be used? All of that has discouraged long cycle investment. So what have we favored? Short cycle investment, things like shale that had a let's say, a 12 to 18 month turnaround time, or things like iPhones that have an 18-month lifespan to them. We've discouraged investment on a 5 to 10-year horizon, and now we're beginning to see, the implications of that. Particularly, again, demand levels are now at those really high levels. And one last point I want to make about commodities: they depend upon the level of demand, not the growth rate of demand. When that level of demand is high, I don't care if it's going up or going down, but if it's above supply, it stresses the market.
Hey, Jeff, let me take the other side for a second. Ed Morse over at Citi had his note out today as well. And he is more constructive short term, but by mid-2022, he sees shale production coming back more than the market expects. A 35% capex rate when it comes to Saudi Arabia as they try and get sustainably up to 13 million barrels of oil a day, and plus Russia and potentially coming back as well. How do you combat those factors?
Well, no, the question is, at what price do you see that investment flow? I'm not just, that oil is out there. We know the shale is there, but you got to get the rig counts up. And right now we're at 73. We've seen 79. And that was insufficient to get the rig counts up. Why? You have ESG issues that make it difficult for the drilling to actually occur. You have commitments by these companies for share buybacks, variable dividends. All that's going to use the cash to do something other than drill. You look at the issuance of debt of high yield in the sector, it has been focused on paying back previous debt, not on drilling. So I agree that oil's in Saudi, that oil's in Russia, that oil's in the U.S. shale patch. But you got to get money to it. And that's the big question mark right now, because even take Saudi Arabia, it's committed to the drilling, it's contracted the rigs, but the rigs are not in the field actively drilling right now. And so was the same thing in Russia. We got to see the actual money flow into activity. And I don't know where that price level is. There's still a big question mark at where is that new equilibrium price. And then once they start doing it, what kind of inflationary pressures do you create within the industry and other types of bottlenecks when you put stress on the system? When was the last time we ramped up drilling activity in this industry? It was third quarter of 2018. That was a long time ago. We'll find out with the ability for it to do it again.